This is brutal financial advice that we all need to hear. Truths that I've learned the hard way over 20 years as a financial advice. Truths that I have found makes the difference between somebody being successful as an investor and somebody failing as an investor and failing to be able to reach their financial goals and retire comfortably. So let's jump in. The first brutal truth is it's critically important to avoid making big mistakes. And they're far too easy to make. If you make one 30% mistake in your investing career, it can wipe out 20 years of hard work. So avoiding those big mistakes, and even a 10% mistake can set you back years. And I don't want to see you make either of those. The most common mistake that I see is people get nervous. They become their own worst enemy in down markets. And even though they may not need the money for 10, 20, 30 years, the stress of seeing their accounts down 20, 30, 40% is just too much for them to handle. And they lock in those losses. So it's critically important we avoid making mistakes like that because they can really derail us. We're going to talk later in the video about how to avoid making those mistakes. Okay, mistake number two. Item number two that you need to know is avoid being greedy. As a financial advisor, occasionally I would hear from people that would say, hey, Azul, I don't want to be greedy. I don't need a big return. I only need 12% a year. I only need 15% a year. Heck, I've even heard I only need a 20% a year return. Well, while 12% returns are possible, and they may happen with an all equity, all stock allocation, for most of us that have a balanced account, we have some bonds, we have some stocks, a 12% return is a super strong long-term return. You may get it, but in the pursuit of going after higher returns, you're setting yourself up to make that first mistake, which is, making a big mistake, making a 10% to a 30% mistake that can set you back for years, if not decades. Okay, related to that is the importance of staying invested. Come up with a long-term asset allocation that you can stick to in good times and bad times, and stay invested. Quit trying to play the game. It is time in the market, not timing the market. When the market starts going down, people will say, well, I'm going to get out now and the market's going to keep falling and then I'll get back in. You know what? That very seldom works out. More often than not, what happens is the same time you're capitulating, the same time the pressure is too great for you, lots of other people are doing the same thing. And it's not unusual for you selling to be at or close to the market bottom, and then things start going up. And you know what? If you didn't, I'm just going to make up numbers here. If you didn't like the market at this level, right? The market was here, it went down here, you got nervous, you sold. If you didn't like it here, when it goes up 10%, 20%, it's going to be even harder to buy in when it's more expensive. People say that they're going to get back in, but they don't. Okay, the next one related to staying invested is to be patient. It takes time. It takes time for compounding to work. It takes time to meet your goals. Early on, when you first start saving money and you're investing that, the majority of the growth that you're going to see in your account is from you putting new money into your account. It's not going to be from the growth of that account. But if you're patient, that base, that foundation will grow and grow and grow. And after a decade, after 15 years, after 20 years, your money that you saved in the past and is now invested, that money is going to work harder for you than you're working for yourself. In other words, it will grow, your base, your foundation will grow at a rate faster than the money that you're putting in. Let's say you're putting in $10,000 a year. Well, if you've saved $500,000, there'll likely be years where your account is up $50,000. and you're putting in $10,000 a year. So your money is working 5 times harder for you than you are, but you have to be patient in order to get there. My grandfather was a farmer, and he made me promise never to be a farmer because it's hard work. But think about a farmer. If my grandfather was growing carrots and he was wondering how the carrots were doing, and he pulled those carrots out of the ground before it was time to harvest, well, he just killed the power of compounding with that carrot, right? We have to be patient. We have to let time run its course. Don't pick those carrots before it's time to harvest. Okay, the next one, related, is don't interrupt the power of compounding. We talked about how this base is going to grow and how your money at some point is going to work harder for you than you are working for putting new money in, but we have to allow that compounding to work. So don't interrupt the power of compounding if you don't have to. And what this means in practical terms is don't take your money out, right? Particularly for your retirement accounts, right? The reason we're saving that money is for retirement. We're not saving it for a home. We're not saving it to help our kids with college. We're not saving it to buy a car. We're saving it for our financial independence, for our freedom, for us to be able to take full advantage of the youth of our senior years, and we need to let that money grow. There's always 100 reasons why, we should take a loan from our 401k, or we should do this, but fight that temptation as hard as you can to allow compounding to work. Because once you start taking money out, you've given up the power of compounding. Okay, the next one is a basic, but super, super important. And that is, no matter how much money you're earning, it's important, it's critical, it's imperative that we spend less than what we earn. Over half of all Americans making $100,000 a year or more, believe it or not, save zero. Don't save a dime. I don't care how much money you're making, you need to figure out a way to save something. It's a good discipline. And unfortunately, that 10% rule, save 10% a year, that many of us learned from our parents, in today's world, I don't think that's enough. Unfortunately, and I know it's aspirational, I think we need to try to get closer to 20%. Super hard to do in today's world, even harder because of inflation. But if we can do that, lots of good things will happen. How do you save 20%? I'm not a big fan of budgeting, detailed budgeting. For some people, that works great. For myself, I tend to set a monthly savings goal. And as long as over a 3 or a 6 month period, I'm averaging that savings goal, then I don't like looking into all the details. Some people like the details. Some people need to do that in order to be able to budget. But I like what I call the 50-30-20 rule. Look at all your spending and separate it into things that are needs. Things like your rent or your mortgage payment. Things like fuel for your car to get to work. Things like food at the grocery store. Things like your utility bill. What are all of your needs in life? Try to keep that down to 50% or less of your after-tax take-home pay before you save anything. So just your gross after-tax take-home pay, if you're married, for you and your spouse, if you have a life partner, for you and that spouse, and try to keep your needs to less than 50%. Now your wants, things like going out to eat, things like buying stuff that shows up in cardboard boxes at our front door, things like taking nice vacations, right? There's nice vacations, and then there's vacations we can take to relax that don't have to cost a lot of money. I put a nice vacation in a want, and I put a normal vacation, or relatively modest cost vacation into a need, right? We need to recharge. But that more expensive vacation, that would go more into the wants. Try to keep those wants to 30% or less. So 50% for your needs, 30% for your wants. Again, this is your gross after-tax take-home pay before savings. 50% on your needs, 30% on your wants, that leaves 20% for savings. So again, it's aspirational. A longer term way to get there, that can be hard to do. A longer term way is every time you get a raise, every time you get a promotion, half of that new money goes into for your future self, for your savings, and half of that money you get to spend some of it. Okay, so that was the next rule. The next one is be wary of risk. Be cognizant of how much risk that you're taking in your portfolio. And the number one tool, well, there's two tools that we have to combat risk. The number one tool, which is not a drag on performance, is time. If you have 20, 30, 40 years and you can avoid blowing out of the market when the market goes down, time can be a wonderful way to buffer risk, that up and down volatility. If you look at the market volatility on a daily basis, it's a little over 50% of the time the market's up, right? If you look at it on a yearly basis, it's probably closer to 60% of the time, 70% of the time the market is up. But if you look at it over a decade, it's 80% plus, 85% plus of the time in a decade, the market is up. It's higher at the end of that decade than it was at the beginning of the decade. And over a 20-year period, it's either at or very close to 100% of the time the market is up. So that's one way to mitigate risk. The other super important way to mitigate risk is make sure you have your asset allocation right. This is going to determine 80% of your investing success is your asset allocation. What percent of your portfolios in stocks, what percents in bonds. And this is so important that I think it's worth hiring somebody to help you with that. Preferably somebody that's a fiduciary to you 100% of the time. Fee-only financial advisors have made that pledge to be fiduciaries to their clients 100% of the time. But you can find other people that are also fiduciaries 100% of the time. You want to make sure people have a fair amount of experience, definitely knowledge, but then also experience. I would look for somebody with a decade of experience. I know that makes it harder for people starting off in the industry, but this is your life savings. I'm looking out for you. So this is not financial advice, but get with somebody that can look at your asset allocation and help you get that right so that you can weather the storm when things are scary. And you're also comfortable leaving some chips on the table when the market does really well and you're underperforming, because it's a balancing act, right? If we're always chasing the highest returns, well, guess what? Anything that can be up 30% in a year, as I record this over the last 12 months, the S&P 500 is up over 30% over the last 12 months. That's a huge return. That's the good news. The bad news is anything that can be up 30% can also be down 30%. Okay, the next one. The next one is simple beats complex. People think, well, simple, it's just too simple. How sophisticated is this? Is this the right plan for me? After over 20 years as a financial advisor, the simpler the plan that meets your goals, the better. Simple does not mean easy. In fact, simple can be super hard. Simple is stay the course when it's challenging out there, when the market is scary. Simple is be greedy when everyone around you is fearful. Warren Buffett's famous quote, right? Simple can be difficult, but simple can also be incredibly powerful if it means you can stay the course. Okay. Another thing with simple is avoid trading too much. More activity feels good. It's not unusual for people to say, oh, my financial advisor doesn't do anything. I don't see any trades in my account. Well, good. That's probably a good thing. I see that as a good sign. Your financial advisor should be meeting with you regularly, should know what your goals are, should know what's important in your life, should know what keeps you awake at night, right? And you should be regularly meeting with them to talk about making good decisions. But activity for activity's sake, I think, is a negative, not a positive. Okay, I want to talk about Should you invest in stocks or should you invest in index funds or mutual funds? Again, not financial advice. I don't know your situation, but here's the thing. First, do you have an interest in stocks, right? The second is, do you have the knowledge? Do you have experience? There are people that have spent their lives studying the stock market. And that knowledge, that background of what has happened in the past, what can happen, these bad things that are not supposed to happen, these black swan events, have a way of happening more often than not. So having a knowledge of the history of the market and the types of things that can happen, better to have that knowledge beforehand than to earn it through experience of your own experience. That can be very painful and very costly. We talked about the cost of a single mistake. Making a 10% mistake, which is super easy to happen, can pay for, let's say an advisor is charging you 1% a year. That pays for 10 years worth of advice, right? Avoiding that 10% mistake. I'm not saying you should use a financial advisor. That's up to you. But should you invest in stocks or should you just high level have this asset allocation, work with somebody for the asset allocation, preferably probably work with a professional as well to choose those investments? You know, the criteria for investing in stocks is you have to have the knowledge. Candidly, few of us do. The second is you have to have that interest. And the third is you have to have the time. It takes a lot of time to really know what's going on with the companies that you've invested in. You want it to be an investment, not a trade. And for it to be an investment, you really need to know what's going on in that company, what their goals are for the next 12 months, what their goals are for the next 36 months, for the next 60 months, what the risks are associated with that company, what things could derail them, what's coming on the horizon that could be a headwind for them. And if those things get triggered, probably better off to make a change before the stock price gets hit, right? Same thing with asset allocation, and I should have mentioned this. If you find yourself in front of your skis, over allocated to stocks, as I record this, the market's at or near all-time highs. It's a heck of a lot easier to readjust your portfolio. Let's say you should be 60% stocks, 40% bonds. I don't know what that is for you, but if you find yourself 10 percentage points, 20% percentage points overweighted in stocks, it's a lot easier to make that adjustment, to sell those stocks, to buy bonds when the market's at all-time highs, when the prices of those stocks are at all-time highs. A lot easier to do it then than after the market has fallen. Let's talk about bonds a little bit more. I talked about the importance of asset allocation. Most of the time, over 10-year, over 20-year periods, bonds in general are going to underperform their stock counterparts. But the role of bonds in a portfolio, in my view, first and foremost, is stability, to have that stability. And yes, the returns are going to lower when you move away from 100% stock allocation, likely. I don't have a crystal ball. My joke is if I did have a crystal ball, it would have a big crack in it. But your bond allocation, by adding bonds, you're decreasing risk potentially exponentially while just decreasing returns linearly. So what some allocation of bonds can do for a portfolio is dramatically reduce the risk while only modestly decreasing the return potential. Asset allocation, critically important. Again, work with a professional to get that right. Okay, so the next thing is questions to stop asking yourself. And the one question is the stock market going to crash? You know what? I've got an answer for you. Is the stock market going to crash? Is the U.S. going to enter a recession? The answer to both of those is yes. I can say that with great certainty. What I cannot say with great certainty is when that's going to happen and how bad that's going to be, right? Trees don't grow to the moon. We've had a series of very strong years of stock market returns. This is not going to continue for the rest of our lives. This is not going to continue for the next 100 years. Market corrections are a feature of the stock market. It is not a bug of the stock market. They're going to happen. I don't know when they're going to happen. I don't know how bad those corrections are going to be. Same thing with the recession, right? We're not going to go 100 years without a recession. It's just the nature of how economies run. So, but quit asking yourself, is the stock market going to crash? Are we going to enter a recession? It's time in the market, not timing the market. If you had invested in the stock market just before the great financial crisis, right, 2007 to 2009, you know what? You would have been fine over the coming 20 years. If you had invested just before COVID happened, right, a 30% drop in the S&P 500 over a 4-week period. If you had invested the day before that happened, you'd be fine. In fact, you'd be better than fine. You'd be very, very happy. You would have had solid return. Would you have been better off waiting 4 weeks? Yes. Would have been better to buy at a 30% lower rate. But none of us can predict that. So quit asking yourself those questions. Quit wasting mind space on that. So the fundamentals are, we need to create savings. We need to create some extra cash, some investments. That we need to create the seed for our investment growth. Then we need to let it grow. Going back to my grandfather, who was a farmer, you know, we need to buy that seed by spending less than what we earn. We need to plant that seed and we need to let it grow. That is allowing it to grow. And then we need to protect that nest egg, the next egg. So we plant the seed for the carrot, we let the carrot grow, and then when it's almost time to harvest, we need to really protect that, right? We need to make sure that the rabbits don't come and eat that carrot before it's time to harvest it. So how do we protect that? How do we protect our asset base? We protect our asset base. We only need to get financially independent once. And then as Warren Buffett says, job number one, rule number one is don't lose money. And rule number two is don't forget rule number one. So the way we protect that is by asset allocation, by taking no more risk than what we need to achieve our goals. And frankly, if you follow all of these points here, many of you are going to become financially independent. And then the challenge is actually admitting to yourself you've won and giving yourself permission to reach out and grab that brass ring and actually retire. Too many people reach financial independence, can retire, and then unfortunately they coast through the youth of their senior years, blissfully unaware of how important that stage of their life is, which is why I made this video up here. Why waiting to retire until you're 65 might be a big mistake. I'll see you in it.